Mike. Thanks for joining us. Mike is with Guaranteed Rate. He's a loan originator with Guaranteed Rate. He's been in the business 23 years now. 22 years. He's family. He's my cousin. Trust him with my life. But we have a lot of similarities in the business. First thing I wanted to ask you is that what are some of the mistakes that maybe first-time home buyers or new borrowers are making today that you've seen over time that's really consistent? And what are some of the things that people can do not to make those mistakes? So, for example, in our business, it's probably like yours. People tend to think that they can get what they had 30 years ago, right? They don't exist.
Of course.
So what have you seen in your business that's like ours? Because today and 30, 40 years ago are two different animals.
Yeah. Well, thanks for having me.
Absolutely.
It's good to be here with you. That's a great question. You know, I think there's a lot of different ways that I could spin that, but the biggest thing that stands out on my mind is lack of preparation, right? Mm-hmm. You know, especially for first-time home buyers, right? You don't know what you don't know. Okay. You know, going out, looking at homes and, you know, not knowing potentially what you could afford, you know, what your credit may actually look like, right? The type of impact that could have on your financing and your mortgage payment, right? And the whole financial picture that goes along with buying a house, you know, not engaging, you know, a loan originator, right, up front before you even start the shopping process, I think is a huge mistake. There's so many different variables, you know, that go into this process, right? You know, you can be out looking at $500,000 homes and not even be able to qualify for it, right? And, you know, you're not just wasting the time of someone who you're speaking with saying, I'm interested in buying your house. You actually could be wasting your own time, you know, because when you finally get to that point in the process, you know, when you start looking at numbers, right, with house prices where they are, you know, with interest rates where they are, granted, you know, they're lower, they're 1% lower than they were a year ago, but they're still somewhat elevated, right? You take into consideration other things that have increased, like insurance costs and property taxes, you know, all of a sudden you realize, oh, wait, we can't qualify, or, you know what, that's just not affordable to us at all. So lack of preparation is definitely big. You know, there could be, you know, discrepancies in a credit score that you get from Credit Karma that looks great, you know, and then a lender who uses completely different versions of FICO scores is looking at a credit score that's 80 points lower. And, you know, all of a sudden, you know, what you thought you would qualify for interest rate wise is not really the case. Right. So just the lack of preparation, you know, if you are in the market looking to buy a home, especially your first home, is get your pre-approval done first, you know, before you do anything else, because it all piggybacks off of that.
Yeah. And I think that's what we did, right?
It is.
We're looking.
Yep.
You know, and I want to touch on something really quick that you had mentioned. You had mentioned that, you know, rates are lower, but if we look back to when we were kids in the 80s, interest rates were what, 15, 16, 17%?
Double digits with points.
So realistically, when someone like me, right, you got me like 2.9%, we were at like right at the crest of we're probably never going to see that again, right?
Probably.
Okay.
Probably. Unless something catastrophic happens.
But that being said, if you look at the rates right now, like say in 30-year average, 30-year home mortgage worth 6.
Yeah, call it 6%. Okay. I mean, that's what the average 30-year fixed is predicted to be for most of 2026. So just call it 6% roughly.
So now let's take that relatively to the past.
Yeah.
6% was really when we had the boom after 9/11, right? Interest rates came down to 6%, and that was hot.
Yeah.
So do you think it's realistically to say when people are like, oh, I want lower than 6, it's kind of stretching what anyone can do in the industry?
Well, I wouldn't say stretching what anyone can do. You know, there are certain programs that, you know, for example, you know, first-time homebuyer programs with income limits. Okay. If you can fall in a very specific bucket, right, and meet income limits, you know, meet a certain credit score requirement, be a first-time home buyer,
and then probably throw a huge chunk down.
Not even, you know, even with as little as 3% down, you could find yourself a 5.75 if everything aligns, you know, correctly. And that's just conventional financing, you know, FHA financing, which has its pros and cons, right? You typically do see interest rates, you know, lower than that to the tune of about 0.25% or more. Same with VA financing. So,
that's veteran financing.
Veteran financing. Yep. So that's reserved strictly for veterans, eligible veterans. And there are still some conventional, programs like 5 or 7 year ARMs. We're definitely seeing, mid to upper fives, right now too. So it's not out of the realm of possibility. But just, generally speaking, national average, which my company's always going to be a little bit better than that, 6%, is just a safe number, to base things off.
Can we pull up a chart to, what were you saying?
Oh, yeah. I think he has it up now. Yep.
So look at, what's that, 1980. Look at that massive spike.
You're over 18%.
Right.
So you got interest rate on the left-hand side, and then you got, the decades below that. So you can see we were, over 18%. That's probably close to 20%, somewhere in I would put that in like the 82, 83 range right there.
Yeah, probably.
Granted, home prices were significantly less.
Oh, yeah.
Probably, on average,
100,000,
but maybe not even, maybe 50,000, depending on the market. But, over time, we've definitely worked our way down below those double digits. And I would say probably since about 94, 95 there, it looks like they stay within that single digit range. But to your point, shortly after 2000,
still low.
Right. We're above 6%. That's probably like 6.75, which we were, a year ago. It's exactly where we were. And then now if you look all the way to the end of the chart, you see we're just sitting slightly above 6. So, based on surveys of, nationwide lenders, that's where all this data comes from.
Yeah.
But, 6%, 30-year fixed rate, is pretty much what the market's dictating right now.
Right. But as a whole, I mean, if you take this chart and you're looking at it, where we are today is not bad at all.
It's not bad at all. The challenge that we have is
the overinflated home price.
The overinflated home prices.
Yeah. That's what we've been experiencing. And I like, just to even paint this little podcast room that we have, not even the full room, it's just a couple of walls. The gallon of paint was $100.
Yeah. It's crazy.
It's $100 for a gallon.
I know.
I remember when you helped me paint the gym when I had the gym.
Yep.
I got a 5-gallon bucket of paint. I think it was $50-$60.
If that, I remember.
Of
course.
Let me ask you this. So let's say someone's looking to take out a home equity. Yep. Let's say they want to do improvements to the house.
Yep.
How have you seen construction prices rise over the past couple of years? Because on our end, we try to explain to the customer, hey, this policy is obligated to pay you full replacement costs, so we have to give you back what you had.
Right.
And a bathroom doesn't cost $12,000 anymore. It's more like $22,000. So how can we insure something that costs more? So what have you seen on your end when it comes to the home equity side?
Well, when folks are using it for home improvement purposes, they definitely need more than they did in the past. The inflation rate of construction costs has gone up quite a bit, and I think insurance rates have followed suit, right?
Absolutely.
I mean, the cost to rebuild homes is now
astronomical,
significantly higher. Just we look at premiums up 30-40% from even just a few years ago, right? In some cases, especially coastal markets.
Oh yeah, forget the coast.
Oh, crazy. But people definitely need more, like a gut, renovation someone could do back then, depending on the extent of the work, like 80 to 100,000, you need at least 150, to do something like that today. Right. And, that's not including all the bells and whistles, right? Like,
oh yeah.
I mean, it depending on your finishings and everything else, I mean, it could be significantly higher. I have, clients looking to do additions, and we line up, home equity financing. And in some cases there is enough, to make what we think they'll need work. And then they come back and they're like, yeah, forget that. We're going to go buy a new house.
Yeah.
It's just
not even worth it.
It's not even worth it. It's just too expensive.
I think your father-in-law told me, what did he put his in-ground pool in? Was it 10,000 instead?
Yeah.
Do you know what it is to put a pool in nowadays? It's like 80, 90, $100,000.
Yeah. At least 100.
Yeah.
At least for a nice in-ground. And you're just talking like fiberglass too. Like you're not talking like pouring concrete, right?
They don't make
just drop it in,
dig the holes. There you go.
You're looking at an easy 100,000. Easy. by the time you do the concrete and everything around it, right? Like it's insane. And, the pool is great to have, but you'll never get your money back.
I was just going to ask you that. Like is that a good investment, or are you better off when it comes to putting money in your house? Are you better off with the kitchen, the bathroom? Because I know with us, when you were helping us, we were looking, I'm like, I don't want to renovate a house. I just want a turnkey.
Yeah.
And it was hard to find because everything in Newtown needed work within our budget.
Yeah. It's a great question. If you're looking to maximize property value, the pool is not the way to go. You could spend $100,000 on a pool, and in an appraisal, probably get credit for about $25,000, give or take. Right. So, and the reason why is you split the market. Right.
What do you mean by that?
So half the people buying a house want a pool. Half the people buying a house don't want a pool. Right. So, there's a market factor adjustment, that's built into the pool as well. Right. In some cases, it could be a deterrent for 50% of the buyer pool.
Yeah. Who wants to take care of it? Then you got the electric bill and the water bill.
Costs, repairs, everything else that goes along with it. Right. If you're trying to maximize your property value. Yeah. Kitchens, baths, floors, windows, siding, things that aesthetically,
curb appeal
does help. Absolutely.
What about backyard patios? How the people are putting in the built-in, like, what do you got?
Bobby Flay kitchens.
Yeah, there you
go. Again, I put that more in the category of, personal choice, than maximizing property value. Mm-hmm. Like, are you going to get a higher value for having a deck over a patio? Yeah, a little bit, right? But are you going to get more value with a completely redone kitchen versus a kitchen that's 15 years old? You're going to get way more value out of that kitchen, way more value, right? So again, over improving a home is true. You can absolutely over improve your home with these, outdoor kitchens and, things that are, only seasonal use, right? They're not going to add dollar for dollar value to your home the way that most people think they do. A lot of people still think like every dollar I put in my home, it's adding value. I just replaced my roof. Guess what? That's maintenance. Yeah. You got to do it every 15 to 25 years, right? So that's maintenance. If you got a new roof, great for your new buyers, right? Or great for you. You don't have to do it for a while. You spent $15,000 on a roof. Your property value did not go up $15,000.
Yeah, no way.
Not at all.
I mean, if I bought it, my insurance would go down because it's a massive discount.
It could help you there, absolutely. But in terms of increasing your property value, no. A new roof, gutters, no. That's just that's more maintenance. So, if you stick to the cosmetic improvements, those are always going to boost.
What about the garage? You see a lot of guys now putting in, like the gym flooring in the garage. They'll put all kinds of make it a man cave. Is that again 50-50?
Still a garage.
Yeah.
It's still
some people want it as storage. Some people want to use it. You cut half the okay.
It's still a garage. I mean, great. Like if you're, you love doing CrossFit at home, and you deck out your garage, to create a great workout space. Great, but to an appraiser, that's just your personal use. That's not something that's going to change your property value. Because when you leave, you could just take all that with you. Right? It's not affixed to the home. It's
it's like that movie with Richard Pryor. No, I didn't say we were taking the refrigerator. I said we were taking the pool. I said just
Exactly.
I want to touch on not appraisers, but inspections.
Yeah.
So when we had our inspection, they can only see so much. Sure. And I know that from experience myself going through that regardless of how great they are and how many crevices and corners they get in, they can't find everything, right? Like,
sure.
As you well know, with a home, you're running into finding things over time.
Yep.
Right?
Yep.
Like, this pipe shakes, that's not good. Lights start to flicker, that's not good. None of the windows close properly, but they're like, okay, it works.
Yeah.
Can you go into a little of extra steps a buyer can take?
Yeah. Well, I mean, number one, it's always recommended to get a home inspection. Okay. Now we were in a market for a few years there, where good luck just getting under contract, with any type of contingency, a home inspection, appraisal, in some cases, even a mortgage contingency, right? The market was incredibly competitive, especially when interest rates were at those, 3% levels. Even when they crept up, into that 6% range, that, shift in the market, of having those contingencies was still incredibly challenging to get your home under contract with. About midway through last year, I would say the shift came back in the other direction. We're seeing contingencies again. Home inspections are becoming routine again, appraisal contingencies. And now something that was just a kiss of death before, home sale contingencies. I've had a few recently, which is interesting.
Contingent on
selling a home, right?
Oh, so the buyer selling their property
has to sell their property to buy the next one, and sellers are willing to wait, for the right property. If it's got some time on market and they're not getting any bites, they have to right now. So it's definitely slowed down. And it's helped the buyer, and getting back to the home inspection contingency side. It's become commonplace again.
I mean, you see new construction though everywhere. At least here in PA. I mean, everywhere there's new construction. Like on the bypass, they just built all these McMansions, and you start going into like Holland and over there, and then they just built this massive development on the way into Warminster. So is there less supply, or is there supply coming, or is it a combination of the demand is lower and the supply is lower?
I think it's a combination of the demand and the supply being lower. Inventory has not improved,
even with all the building that's going on,
because, you have to think about, that new construction. It's not cheap, interest rates are still elevated, right? So you only have a certain, percentage of the population that can afford it, can afford the new construction, right? And, in the suburbs and everything else, supply still remains low. And in my opinion, and I think a lot of people would agree with this, interest rates have a lot to do with that, right? Sellers, they have no incentive to sell right now. They're sitting on a 2.99 mortgage, right?
Getting rid of that.
Right? They all say, I'm never getting rid of that, right?
My account always says, here's the good news.
Make do.
Your interest rate's 2.9%. Here's the bad news. That's the only thing,
right? So you have homeowners that, they may want a new house or may want more space. They don't necessarily need it. They just want it. And again, because they have that, 3% interest rate,
they're staying put.
Right? Yeah. There's a big difference between, needing and wanting, right, in this market right now. So, that has definitely affected, the selling side of the market as far as, inventory. And buyer demand has definitely calmed down. That's one of the reasons why I just mentioned, like, things like home inspections are becoming routine again, right? So, you have a little combination of both. I think both supply and demand are down right now. Interest rates have come down recently, over the past few months. Incredibly helpful. We are starting to see buyer demand pick up, a little bit more, but inventory still remains what it is.
So what are the advantages of obviously the interest rates are lower, and it may take you a little bit longer to find something, but what are some of the advantages right now to actually buy or refinance?
To buy, I think you have more leverage as a buyer right now, right? Because, the demand seems to be lower for whatever reason. It could be just seasonal, right? Not many people want to go out and shop for homes with, 2 feet of snow on the ground.
Yeah. Well, the reason I ask, I mean, you've seen it at its peak, its lowest, its peak, and here you are again. So you've seen this cycle happen over decades.
Yep.
So it could, like you said, just be, the real estate market may go back to a seasonal market where the house goes on the market in the spring, kids are looking to move in the summer, then they have to enroll in school. So, but I think, like you were saying, that, those years where COVID was around, the buying season was all year.
Right? It was all year because it was basically free money. what you could get for, a $500,000 house at, 2.75% cost you $1,000 less a month than it does today,
I can't believe how much principal I've paid over the years. It's crazy.
Literally, right? But, we are expecting spring to pick up this year. Given the lower interest rates, purchase applications are up, I think, anywhere about like 18 to 20% right now. So it's building, right? So with the lower rates, definitely going to be more buying activity. So competition's going to go up again, could drive home values up, even a little bit more, because competition obviously, is what, brought home prices to where they are now, right? Just overbidding and overbidding and overbidding, right? You had a lot of cash influence and some institutional stuff going on, that certainly didn't help. But that's definitely been, calmed down, quite frankly, like eliminated in a lot of cases. But, season definitely, is a factor. Lower interest rates. This should be a good year, for buyers. That I think, are going to have a little bit more leverage than they have in years past. But again, you get back into these really low interest rates, you start throwing, low 5s to even like high 4s out there. Now you have sellers, all right, you know what, I think like wanting that bigger house psychologically
makes more sense now.
It makes more sense now. Yeah. All right. I'll walk away from 3%. It's 4.75. It's not the end of the world.
Yeah.
We got a ton of equity. We got a lot to put down, so I think we're getting back to, to a market like that, but it's going to take time. I still think we're a couple years out.
That's anything. What are some of the red flags when you're trying to interview or select a loan officer, a mortgage originator? What are some of the tips that you can give, like maybe a new home buyer or somebody who's looking now that could say, hey, you may want to steer away from this. This is a good trait. So on and so forth.
It's a great question. As they say, who you work with matters.
Oh, yeah.
And it really does. It really does. My best recommendation would be, stay with local lenders, as much as you can. Because
people who know the market.
People who know the market. Yeah. We know the market. Your local real estate agent knows the market, right? They're going to put you in touch with, good lenders. Far too many times, you start going straight to the bank or, national lenders where, they're in Michigan, for example, they just don't know your market. They can very easily deliver numbers to you that are inaccurate because they don't know how certain things like property tax adjustments and, other local, state requirements and taxes and things like that. They just don't understand how they operate. You could, go through a process and all of a sudden
you get to the closing table.
It's $10,000 more than you were expecting. Right. It's a lot. So definitely do your due diligence, work with someone local. If you can, it can really make the process so much more efficient. And try to, do some due diligence on the person you're working with too, go out, read reviews, they've got a lot of great reviews. That's great. People typically only write reviews
when they're pissed off.
So, check out the individual as well. And if they have a local presence and, you could see they've, done good things, for, their clients over the years, I think you're in great hands.
Yeah. I think that people also, as a consumer, they have to keep things into a perspective, right? Like you were saying, need and want.
Sure.
Like, I think a lot of times that what I've seen in the past and what's come through our office, at least when it comes to the insurance, they're trying to push that buyer into something where it's really going to stretch their income. Yeah. Because I know is the DTI still 55% or is that creeping down?
Depends on the loan program, but they could range, anywhere from 43 to, around 55 and some change, for government programs like FHA and VA.
And then you think a good tip for anyone buying right now is be mindful that even though you may have a 30-year fixed mortgage, your taxes are going to go up. Your insurance is going to go up.
Yeah.
Your real estate taxes are going to go up.
Yeah.
So always be prepared to maybe live a little bit below your
absolutely.
cost of living.
Absolutely. And, the mistake that a lot of, lenders or, loan officers make, I think, is, look, your income may say you're pre-approved for $1 million.
Oh yeah, but you don't want to make that $8,000 payment a month,
right? And maybe you have 10% to put down, on $1 million. But when I show you what that payment looks like, you're not going to want to be pre-approved for $1 million, right? So, when I take on a new client, it's like, look, one, I could tell you what your max affordability is, but you also know what your max affordability is, right? So we need to have a conversation,
an honest
about
conversation.
That, because what I may pre-approve you for may look great on paper in that letter, right? But when we actually start putting the numbers together for specific homes, that monthly payment's not going to be attractive. And you just went out and saw 4 houses that you fell in love with, and you're like, we can't manage this, not with 2-3 kids and school and sports expenses and everything else we have in our life right now. Everything that's increased.
Oh yeah,
not just taxes and insurance. So,
dude, I went to the supermarket the other day. We used to be able to buy a pack of gum for like a quarter. It's like $1.50 now. I'm like, what happened? Big League Chew? Remember that?
Yep. Yeah. I think Big League Chew is like $5 a pack now. It's crazy.
Oh my God, I don't even want to know.
It's crazy.
Are underwriting, is it still mostly done by humans, or have the banks and the lenders started using AI? Have you seen that muddy the water at all? Or
yeah, it's a great question. So Guaranteed Rate is big on technology. We're definitely a technology-based lender. I think it depends on the institution, right? But, we know the value of technology and AI. And, when I, send the client an application to fill out, it's pretty impressive what comes back, right? The application's completed. I got an email that lists, potential red flags. It lists, what their target payment range looks like. It has their income numbers already verified via third-party reports. Their bank accounts are verified, via an asset validation tool that's built into the application. And it can literally come back, gone through, automated underwriting, like with a pre-approval attached to the email. And I didn't even have to step into the file. This is incredible.
So the days of a loan taking 60 days are over.
Yeah. Or the days of, taking the application over the phone, typing in their social security number wrong, pulling credit. Oh shit, I had their social security number wrong. I got to pull the credit again. They're getting hit with a second. Like the days of, the kind of the labor intensive application process, like
human error,
it's significantly reduced.
Interesting.
And, we have, a program that's called Same Day Mortgage, where if, all of these asset validation tools work with their application, then there is one person involved in the whole process. Typically you have openers and, a couple processors and the underwriter, and, you have like a team of people working on your application. We have just one, they call them a same day underwriter, where all these asset validation tools come in. They have everything they need up front. They get a clear to close on their mortgage in one day because of all the AI tools.
Crazy. So there's really
one day.
As much as we want to avoid Big Brother, it's impossible, right?
Yeah, it is impossible. I mean, you get a little concerned, especially people might like me. Like, am I going to be out of a job one day, right? But the human element still needs to be there, because as great as technology is, it has its faults.
Oh, it does. Believe me, when I got our latest, I'm not going to say the name, but accounting software, let's say, that everyone uses, imported AI in there. I'm like, oh, this is great. The expense it just automatically categorized everything for me.
Yeah.
And then my accountant, my CPA has the login. He's like, hey, Shawn, we got a lot of work to do. I'm like, what are you talking about? He says the AI miscategorized everything. We've got to go back 12 months. So $3,000 later of going back 12 months of correcting things is absolutely insane.
Right.
And I do agree with you. Technology is great. And I think we bought my house mostly through text and email. I mean, we might have talked a few times.
A couple of times, yeah.
I think today when you're doing a big purchase or you have anything as far as any kind of gaps in liability where you can get sued, you need a person.
I agree.
And we don't have a magic wand, right?
Yep.
The days of calling your mortgage broker, see what you can cut out of the price. We get that every day. I'm like, the computer spits out a number. I have no way of changing everything. And it's funny, our customers still think we have these magic wands that we just pull out and poof, it's $30 a month.
Yeah, exactly.
That's the biggest challenge we're facing because they're seeing these ads on TV. Like I'm sure your borrowers say, oh, the interest rate's as low as 5.9%.
Yep.
Then you run their credit and everything else, and then you find out it's 7.5%. Of
course.
And it's your fault.
Those are all designed to make you pick up the phone.
Yeah. The bait and switch.
Exactly. Yeah. And the devil's always in the details, And a lot of times you ask the client, well, can you send it to me? And you know what you're looking at.
Oh, yeah.
And they may say, yeah, it's a 5.25% interest rate, but the APR is like 5.9%. I'm like, yeah, well, they're charging you 3 points to buy the rate down.
Yeah, on the back. Well, that's the funny thing, too. It's like, we'll get customers, we'll say, look, let me review your policy with you. Send me your declaration pages. They waste the time of blacking out all the prices. They still think we can. Yeah. I'm like, I can't pad this. Those days there's no way we can circumvent the system.
Right.
So exactly. Do you guys find that sometimes buyers think, oh, well, you can cut this out and there's really there's no room anymore?
Yeah. I mean, in some cases there really is no room, margins are incredibly thin. Especially with, what's happened with interest rates, and, there's price compression and things that just happen with interest rates that the regular consumer just has no idea about. There's a whole secondary market with interest rates and, what happens even when they're, closed and sold, in the secondary market, the way they're securitized, in the past. Yeah. I mean, there was room. And to this day, look, there is still some room, but
it's so minimal, right?
Minimal. Yeah. It's not what it used to be. It's really not what it used to be. So, it's, the consumer, again, that's, they've got this, in their hand, and they're just searching and searching and searching and searching. And, they see something and like, oh, well, so-and-so is at 5.3. And I'm like, yeah, what else did they tell you about the 5.3? Well, I that's all I saw. All right. Mm-hmm. Well, let's dig into it. Show me where you found it, and then I'll take a deeper dive, and start to pull out things, in this print, and start showing it to them. And they're like, okay, now, I get it. But yeah, there's a big misconception, out there.
We actually had one of our customers, they were in the process of purchasing a home. The sale fell through. They found another place. They're going with that. And mortgage office calls one of my guys and they say, we got to make that price lower. And he told me and he laughed. And I'm like, do they really think? Because they're going to ask us, what's the first thing you ask for? Evidence of insurance, invoice or paid receipt, and a replacement cost calculator, right?
Exactly.
And if that RCT, that replacement cost isn't correct, it comes back anyway.
Yeah.
So why would they tell us we need that rate to be lower?
Yeah. Well,
that's a huge red flag for me.
My mind immediately goes to a qualifying issue.
Yep.
Right. So, let's say we're doing a conventional loan and the maximum debt to income ratio is 50%, and it's one of the challenges for someone in my position up front because, okay, they're making an offer on a home, right? And I know their debt to income ratio is tight, right? Which means their monthly expenses can't exceed a certain percentage of their monthly gross income. Okay. And in a situation where, they're in love with this house and the debt to income ratio is 49%, how much is the insurance? I don't know. I need your help with that, right? Like I need your help. And it could take some time, it could take a couple days, to figure out what the insurance costs. And they don't have that kind of time. Like that offer needs to be in by midnight, right? So you have to do your best to estimate. My company has a good tool, that's built in. It's a third party system that we use. It does a good job estimating the number. It gets you in the ballpark, but again, it's not perfect. Yeah. And not every company is big on technology, right? You pay for things like that. Not every company wants to pay for those add-ons, right? But it could be a case where, they put $1,200 a month, for the homeowner's insurance, what it would have been 3 or 4 years ago. Yeah. And it's coming in $2,400, a month. And like, we need this to be lower because now they don't qualify anymore. Right. So you got to start looking at, all right, well, what can we do? Right. One, do you want to call the customer and be like, oh, now I need you to pay off a $5,000 credit card, right? To make
so you can just pay your homeowner.
Yeah, so we can now qualify you again to buy the house, right? Just so we can now build in your homeowner's insurance. So oftentimes that's usually the issue of why the lender's calling. Because listen, I've had to make that call too. It's hard, especially certain areas, like coastal market in New Jersey. Oh my God. Like I could give you something like, all right, maybe, or even the system estimates $2,500 for the year. And it's a, $400,000 house, which you're like, all right, seems reasonable. Nowhere near it, right? If the property's in a flood zone, forget it. Like,
funny.
You know how hard it is to, guesstimate what a flood policy is going to be?
It's impossible.
Yeah.
Terry texted me from Island Surf and Sail.
Yeah. He still has that building?
Still has it looks incredible.
Oh, he did redo it. Someone
redid it, lifted it, looks absolutely insane.
Okay.
So he texted me earlier. He's like, hey dude, he's like, I finally got a tenant. I'm getting rid of the surf shop. He's not selling it. He's renting it out.
Yep.
He's like, what kind of policy I need? I'm like, well, you need a lesser's risk, mixed use insurance policy on a barrier island in a flood zone at the most narrow part of Long Beach Island, New Jersey, right?
Yep.
It's it's all high risk. And I know the premium's going to be absolutely absurd.
Exactly.
But he doesn't have a choice.
Yeah.
That's the thing. And that's, when we get customers like, oh yeah, I'm buying a house down the shore. I'm like, be prepared.
Absolutely be prepared.
And my biggest frustration, and again, not with with lenders, it's more of whoever is representing the buyer in a lot of these real estate transactions. They're not disclosing them some important things like you raised, the flood insurance and the insurance in general.
Yep.
Because no carrier right now, admitted carrier, is going to write 25 feet from the beach or 25 feet from the bay or even 5 miles from the coast. And now that the coast has moved from the Atlantic Ocean to like Egg Harbor in the bay and 5 miles from there.
Shawn, I have clients buying homes in South Jersey, a quarter mile from the Delaware, with flood insurance premiums of $6,000-$7,000 a year.
And the house is lifted, right?
Yeah. And again, who's at fault? It could go a few different ways, right? Like one, agents should be doing their due diligence, right? Reading, disclosures. A seller does have to disclose in a flood zone, but I had an instance. FEMA's always changing these maps too. Like always changing. Yeah. I had an instance with a client. Thankfully this worked out very well for them, but the seller, they were in the house like 40 years, no mortgage, nobody telling them they needed flood insurance
because it was so long ago.
Had a creek, a portion of their property fell into a new zone. FEMA rewrote the flood maps. A portion of the property,
which probably hasn't flooded in 40 years.
Not the structure. All of a sudden we get a hit. It goes in the underwriting. They do the flood search and everything. Comes back, flood insurance is required. Everybody's like shocked, right? Thankfully, it wasn't an astronomical cost where things fell apart. But the seller didn't know, the agent didn't know, right? The buyers didn't know.
Well, those situations, we had a customer in Ventnor buying a house in Ventnor.
Oh yeah, you better know you need flood insurance.
The house was maybe a foot off the ground. And I told him, I said, I'll tell you right now, it's going to be 12 grand. Nah, it's not going to be. I said, look, dude, I'm telling you.
Easy.
Week later, he emailed me, sales not going through. I says, why? He's like, the flood insurance. I'm like, I told you. Sometimes we want something so bad.
Yep.
We don't realize, let's slow down and back up a little bit and really take a look at this and holistically of what things could cost.
Yeah. Yeah. But that's probably a reason why you got that call from the lender. Yeah. I think it's a qualifying issue.
So if anybody's watching this wants to get in touch with you, we're going to put all of your info in the link, but do you have anything that you want to throw out there as far as how they can get in touch with you, website, email?
Yeah. Kind of all of the above, call, text, email. We'll put my personal website link, on there as well.
We'll put all your handles in there.
Yeah, absolutely. I make myself accessible. So, however someone wants to get in touch with me, they can find me through any of those channels.
Awesome. Yeah. All right, Mike, thanks so much.
Yeah, man, thanks for having me. I appreciate it.